Today we're going to be talking about a single chart that has the potential to completely derail the current situation with markets rebounding, things going relatively smoothly in the last few weeks and months. We're going to talk about the one chart that could ruin this whole setup and throw a wrench into what the Fed and the Trump administration wants to do. Let's jump into it. So the world seems to be right now bracing for an intensifying Iran-Israel conflict, calling this, according to the article here, a terrible spiral of escalation. All eyes are on the White House as U.S. President Donald Trump weighs carrying out direct military strikes on Iran. Leaders from the UK, Russia, China, Germany, and beyond have weighed in on the growing conflict, which is showing no signs of de-escalating. And chances at diplomacy are looking increasingly bleak as Iran and Israel continue to trade increasingly deadly blows. Now, this is a heavy subject, but I want to talk about the one chart that is showing you minute to minute what's happening over there. And here it is, the one chart that can completely derail the current state of markets is oil. Oil prices have dramatically risen from their lows in the April low session. We can see here from there, you're looking at almost a 40% gain. That is almost a 40% gain in the price of oil. Now, let me ask you, do you think a 40% increase in the price of oil could have an impact on inflation? Most people in my live stream today, I asked them this question, and it was a huge resounding understanding from the audience that rising oil prices has a huge factor in causing inflation to resurface. And so with oil prices rebounding here, they've come down a long way, but this completely derails the campaign, the strategy of both the Fed and the Trump administration if things get out of hand from here. From a technical basis, we've seen a downtrend in oil in the last few months that is completely unwound in the matter of a few days based on this conflict happening in the Middle East. And just when it looked like inflation was getting back to normal, this poses a serious risk to that story. If geopolitical conflict escalates, if the United States becomes more involved in the war, this could lead to the existing supply of oil and the marketplace seeing a flood in demand for oil prices and potentially some decreases in supply due to sanctions, due to military actions, due to destruction of oil facilities. All these sorts of things could cause the price of oil to go up. And remember that pretty much everything that we consume is impacted by the price of oil. At the end of the day, trains, planes, trucks, boats, all these things that move things require, for the most part, a huge amount of oil. And so the price of oil going up could cause this inflation story to materially worsen. And this is why this single chart, oil, has the potential to completely disrupt everything that's been going pretty well here in recent times. We've had inflation cooling, we've had stock markets rebounding nicely, but this rise in oil prices, I can't understate that if you start to see breakouts beyond levels like 80, we're sitting in a potentially threatening position, and indices could give back some of their gains in response to this. But before we move on from commodities, let's also take a look at the price of gold, which is sitting coiled up here just at the all-time highs. But why didn't it have a huge push higher here? Well, a big reason for that might have been yesterday's hawkishness from Jerome Powell. Central bank statements and Powell's comments showed deepening concern about inflation despite signs of economic slowdown. And if you stick around till the end of this video, you will definitely see my strong take on this thing. I think rate cuts should actually be happening sooner, and that the Fed being too reluctant could put us in an even worse situation in terms of rate cuts. Now, of course, you do have the inflation concerns due to oil prices potentially moving up, but we're seeing some material weakening in the economy that I think is worth noting. So for example, if we take a look at our US economic heat map on the Edge Finder, you can see most of our metrics here are suggesting weakness for the US dollar. For example, retail sales was a miss. If you take a look at PMIs, we see some weakening data here. If you take a look at ADP numbers, this is jobs report stuff, some weakness there. We also had the initial jobless claims come in as expected, but still sitting at 245,000. So we are seeing some weakness in some economic prints here recently that I think suggests the Fed should be cutting interest rates soon. And so when we look at gold prices, you can see that right around when the press conference occurred and we got that hawkish tone from Jerome Powell, the price of gold actually dropped and continued to drop. That is until we got more geopolitical concerning stuff that happened overnight, causing the bounce back in gold prices. That being said, if the Fed does decide to change its tone and sees more proof that we should be cutting interest rates, I think gold is going to actually really break out and move higher from here. Now we have geopolitical concerns to worry about. We also have, of course, cooling inflation, which I think is likely set to continue due to potentially some slowdown in the economy that we're starting to see materialize in the labor statistics. So I do like the upside for gold, and we'll be looking for either a pullback to this area of support around 3,300 or a breakout and retest of these previous highs to look for an opportunity to get back in on the long side here. And you can see on the top setups page that gold is getting a +10 score, or a very bullish bias, based on the sentiment, technical, and economic data currently pulled in and automatically scored by the Edge Finder. By the way, if you're interested in trying out the Edge Finder, we'll leave a link in the description down below to where you can apply for a 30-day trial of the tool. If that's something that you're interested in and would like some more details about how our trials function, use the link in the description down below to find out more and try out our tools. If you're looking to filter out all sorts of different macroeconomic data and sentiment data and technical reads with a singular tool that is based in your browser, can be taken on the go with you in your phone, on your desktop, on your laptop, etc. It's very easy to get access to it. It is a simple browser-based link that we send you, and we grant your access to it. So if you're interested in trying the Edge Finder, click the link in the description down below to apply for a trial. Silver is also getting a very bullish reading on the Edge Finder, and I actually love the idea of potentially getting long on silver because I do think that there may be an opportunity here if you get a move back down to like 34.50 to buy this level of past resistance that could have turned now support. So I do like the idea of getting long silver. I think the chart actually looks better than gold personally. We've had a multi-month high breakout here to the upside, showing clear strength where gold has still kind of hovered below its all-time high. I do like the idea of actually picking up silver on a pullback. And so in the meeting yesterday, we saw that the forward projections for the 30th of July meeting increase probabilities that we are not going to see an interest rate cut and decrease the possibility of a rate cut, at least according to the bond market. Going out till September, this is where the market kind of thinks that we are going to get a rate cut with a 400 to 425 basis points expectation, or 4.25% rate, currently sitting at 4.5%. The expectation that this number will remain unchanged is around 36%. And so we'll keep an eye on this to see how it progresses. If we take a look at the last available meeting for the year, you can see that the expectation is for around 2 rate cuts this year. The dollar index seems to be catching a slight bid here at support due to the geopolitical stuff. We did see a spike in the dollar, both from that as well as from the press conference yesterday. There was a bit of bullishness on behalf of the dollar here around when Powell spoke here. You can see that his hawkish leaning comments definitely gave a little bit of bullishness to the US dollar. And today's video is sponsored by DNA Funded. If you're looking to get funded this year and you are looking for some good deals, check out DNA down below in the description. They offer payouts in as low as 7 days. You can trade pretty much everything under one single prop firm, and they offer a special discount to my subscribers with the promo code that you see on your screen right now, A1T20. So get 20% off any of their challenges using the link and promo code in the description down below. In today's podcast episode with Johnny Hart and Kenny, I actually spoke a little bit about my thoughts on the Powell circumstance and whether or not the bickering back and forth between Donald Trump and Jerome Powell is very valid in either direction, and my overall thoughts on this. And if you're interested in checking out the full podcast, we'll leave the full link in the description down below for you to watch that or listen to that while you're on the go or wherever is convenient for you on the different podcasting apps.
Plenty to talk about, because over the last 24 hours, we've heard from the US Fed, we've heard from the Bank of England and the Swiss National Bank. Let's start with your side of the pond, Nick, and no surprise that the US Fed opted to keep its key interest rate unchanged. It says it's going to await further information on the impact of tariffs and other possible disruptions on the economy. Of course, we've got this geopolitical stuff going on at the moment, but that didn't surprise markets this year. But I'm also interested to know from you, Nick, on forward guidance and what Jay Powell indicated in his statement after that announcement.
Yeah, Johnny. So yesterday we heard from Jerome Powell, as you mentioned, who sounded pretty hawkish. And I want to talk about a few things that we got out of the press conference that I found interesting, some noteworthy things. Now, of course, if we just first start by taking a look at what the bond market sort of had expected, as you mentioned, there was no expected rate cut yesterday. So there was no cut. That was largely expected, but the dot plot came out and it expected 2 cuts for the remainder of this year, pretty much in line with what people were thinking. So what was interesting, however, is Powell's delivery and his press conference responses to many of the different reporters in the room. And just taking a look at the dollar index before getting into that, we had an initial move back and forth here, but then a push higher on the dollar yesterday once basically Jerome Powell started speaking at the press conference. And it specifically, there were several questions about why are we not cutting interest rates that I want to talk about. But specifically, Powell made many mentions to the uncertainties that have been brought on through the trade dynamics that are a constant moving target here in the United States, with, of course, the Trump administration constantly going back and forth and negotiating with all these other countries. There is this concern from the chairman that inflation could reignite with what's happening in those trade dynamics. Now, I'm going to do my best to stay unbiased in this, but I do have a bias that will leak out in this. The data that the market is looking at in terms of inflation, here's a couple quick facts to think about. The CPI report that we've had in the last 4 reported numbers, all 4 of them were less than expected. The labor statistics, while holding up decently well, are showing signs of cooling. We're pretty close to 250,000 weekly jobless claims in the United States, which is signaling some slowdown in the labor statistics. So I think the real gripe yesterday, the grit in that, there was some tension in the room with the press conference as to why is Powell not cutting interest rates when some of the data arguably could be suggestive of, hey, rate cuts are probably coming down the pipeline. Now, I think it's fair to say that if there wasn't so much uncertainty around tariffs, or the stock market was down still, rate cuts will be happening right away. In my opinion, I think that's probably what would, but there's this uncertainty that comes with the tariff situation. There's this, I get that, but the big question of the day, and it's one that I've been talking about on the podcast, is the Fed back in 2021 made the mistake of trying to forecast the quote unquote transitory inflation, and it got them into a lot of trouble. But now I see this concerning thing that even there was a question in the audience from the press conference. A reporter asked, isn't the Fed supposed to be data dependent? And isn't the data suggesting, if we're looking at it, that most of our economic readings are suggesting some cooling off, and that perhaps we could not necessarily cut to 0 interest rates per se, but reduce that Fed target rate. And so, Powell stood his ground, essentially remaining pretty hawkish and saying that they want to wait for more clarity. He believes they can wait for more clarity, which is understandable, especially given the rise in oil prices, which is a fair thing to note as well. That's something that we know is an input to the economy, and I would say is even more so of a piece of information than the uncertainty that we have with tariffs. But it was, like I said, a largely hawkish reported press conference, and continuing to hold rates where they are. And we'll see where things go. I mean, of course, Powell, I think for the most part over the last few years has done a pretty good job given a very difficult landscape. So I don't want to come across as hypercritical, but I do think at some point you have to say, okay, are we being data dependent, or are we being are we being forecasting with the tariffs? And that's the wobbly middle ground that I think Powell and team find themselves in right now.
You say that Jay Powell has done a pretty good job over the last couple of years, but I don't think President Trump agrees with you. Ahead of yesterday's meeting, Trump called Powell, quote unquote, not a smart person.
And if you made it through that clip, then I've got a little bit more from today's live stream where I went in more detail on why I actually think that the Fed should be cutting interest rates sooner rather than later. Check this out. I actually did not love what we heard from Powell yesterday. And you guys know I am mostly a fan of Powell. Like I'm not like anti-Powell. And I'm not but yesterday we had so much of, hey, tariffs are going to cause inflation. Tariffs are going to cause inflation. And here's my challenge with that, right? The Fed says they are data dependent. Data dependent means you look at CPI, PPI, PCE, NFP, unemployment rate, PMIs. You look at that stuff, right? That's what you base your decisions on, right? But then you're looking at tariffs and making a prediction that it's going to cause inflation, when the economic community has mixed expectations on whether or not tariffs will cause significant inflation, a little bit inflation, little to no inflation, right? There is an expectation that there will be rises in prices, but there's so much more to it, right? Let me just give you a quick example. If you have tariffs increase and it causes prices to go up, and in response, people spend less because they simply can't afford the higher prices, if that happens, that's an economic hit. That wouldn't cutting interest rates help with that story? If you're going to not cut interest rates because tariffs are potentially coming, or they're coming down the pipeline and they could cause a rise in prices, great. But here's the problem. You're making a prediction when you're supposed to be data dependent. And so that's the tricky part for me, right? Glenn, yes, that was the question that I loved. A reporter asked a very similar question about forward projections, and Powell pointed to their rate hikes as the pandemic happened as a time the Fed was more forward looking. Yeah, so that's what I'm saying, is that when we had back in 2022, right? Let's go back in history for a second. When Powell got in a lot of, hot water for being sort of forward-looking, right? And again, you might say, well, the Fed should be forward-looking, right? Well, sometimes it can get them in a lot of trouble. Remember when everybody kept hearing the word transitory? Do you guys remember that? Was anybody trading during that time? Does anybody remember the infamous transitory days? Type yes in the chat if you remember that. If you were trading during that time, or even if you weren't trading but you just heard it, that was a big prediction that Powell and team made, and it ended up costing us big time, because they said they believed that the supply shocks were going to be a temporary problem and that inflation was going to come right back down, right? So here's my problem. Here's my problem with this is, again, I understand the need to be slow and steady with rate cuts, but at this point, we have inflation at 2.4% and the Fed's target rate at 4.5%. There's room, in my view, with a labor data point that's cooling, labor statistics cooling. GDP expectations from the Fed themselves were expected to come down. They announced that yesterday. And so I'm looking at this and I'm saying, wait a second, shouldn't we be cutting interest rates? So this is what happened in response to that, by the way. The whole transitory thing led us to having very high, multi-decade high inflation rates. And so that was a huge problem, because the Fed was like, no, we don't need to raise rates. It's going to be, the inflation's transitory. And it led to a massive move higher. So now he has a very hard job. And I know it's easy to pick on Jerome Powell because he has to have the job of, it's always easy to pick on somebody in hindsight. I get that. But by Powell's own definition of, after making that mistake, he said, essentially, we messed up. We are going to be data dependent from here on out. That means looking at the data and making rate decisions, and QE or QT, right? Quantitative tightening or quantitative easing, based on the data that's coming in, not what we think is going to happen next. So this is the problem that I have with this scenario, is now we have a scenario in which they're making a big prediction about tariffs, where they're saying it's going to cause a whole bunch of inflation. But what if it doesn't cause inflation, but in fact it instead causes economic slowdown, and you refuse to cut interest rates because you thought it could be inflationary? You made a prediction, right, that it could be inflationary. So this is, do you see what I'm saying? I don't know if this is resonating, if this makes sense, but to me, it sounds like, and again, I have been, on my channel and my videos for the last few years, I've been mostly a proponent of Powell, but I do think that Powell should not be so hawkish in the circumstance that we're sitting in. Now, I do understand that there is the uncertainty of what's going to happen in the Middle East. We don't know, right? But by not just being like, hey, you know what, inflation's come down a lot, and the data and the labor data and the PMIs, it looks soft, right? Look at the data. Look at this data. This is the economic heat map, okay? We have a number of things here that are suggesting, in my perspective, that the Fed should go ahead and be cutting rates. We have PMI data that looks soft. That's forward projections from key people in the economy suggesting that sales growth and hiring and all this stuff that they have indicators of within their own personal businesses, they're suggesting a little bit of contraction going forward. And retail sales was a big miss here recently. And the producer price index and CPI, these things are showing inflation is cooling, right? And then you have, if we take a look at ADP was a mess. It was a big miss. You have mortgage applications were down. That's another forward indicator. Housing is a big indicator of the economy. So you have all these things happening. The USD impact here on our chart here is 36%. That is suggesting that most indicators here are projecting for a weaker dollar based on the economic data. So again, that is where personally, I think that the Fed probably should be cutting rates. And I think part of the reason, not the only reason, we also have geopolitical stuff happening today. I think part of the reason the market may be trading a little bit lower now is because they're saying, hey, Powell's choosing not to cut rates. And that could get us into some issues, right? So yeah, it's difficult.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.